Wall Street's so-called fear gauge, the VIX, is raising red flags. After a sharp spike this April, the index is settling at unusually high levels, suggesting investors are bracing for more turbulence ahead. But volatility doesn't just signal panic, it can also present opportunity. Let's look at what the VIX tells us and 2 ways investors can trade around it. The Cboe Volatility Index, better known as the VIX, was created in 1990 as a direct result of the '87 crash. We won't get into the details of how the VIX is calculated, but what's important to know is that it's forward-looking, reflecting how investors expect the S&P 500 will perform in 30 days. When the VIX is high, it means investors expect bigger price swings, maybe even a market crash. When it's low, investors expect calmer conditions and more stability. In April, the VIX rose past 50. And we can see from this chart, the only times in the last 20 years that it crossed the 50-point mark were during the pandemic and the 2008 financial crisis, which goes to show just how worried Wall Street is. Now let's see how you can create an investing opportunity during this time of fear. First, we'll hear from someone who has been on Wall Street for over 40 years.
I'm Nick Colas, co-founder of Data Trek Research. Generally speaking, the more fear there is in the market, the better a time it is to invest. You want to be ideally investing when everybody else is scared. And then when everybody else calms down, you usually have made quite a good bit of money. So we tell our clients to look for VIX levels of 35 and 43. And those are 2 and 3 standard deviations above the long-run average. In non-statistical terms, that means we're at very unusual and highly unusual levels of volatility and fear. 43 historically has been a good time to buy if you want to hold stocks for between 1 and 3 years. Very productive. That tends to be close to a low. But you can have even more panic. Best thing you can say is that if you see a VIX that's north of 70, just a huge outlier reading, that has to be a low, because that is now so many standard deviations above the long-run mean that you know you're in very fearful times and, generally speaking, very low stock prices. But it's a sliding scale, and the only thing we say is anything north of 35 historically says there's a policy response required. It could take a little bit of time, it could take a long time, but it always does happen, and then stocks begin to rally again.
The next strategy is from someone who analyzed decades of trading data and came up with a strategy that might be more appealing to the more risk-averse investor.
I'm Alan Moreira. I'm an associate professor of finance at the University of Rochester Simon Business School. My research with Tyler and Moreira shows how to use the VIX to decide how much to allocate to the stock market. It's really simple. When the market is expected to be calm, you invest more. When the market is expected to be bumpy, you invest less. For example, let's say that VIX is 20, right about average. So you stick with your desired long-term portfolio, let's say 50% equity, 50% cash. Now if VIX were to climb to 40, like it happened recently, then you would cut your positions to 25% equity. If instead VIX would go down to 10, then you would double your equity position to 100%. So formally we say that the strategy weights are inversely proportional to VIX. So when VIX goes up, you get out of equities. When VIX go down, you go in. This approach over the last 100 years has produced returns that are very similar to the traditional buy and hold approach, but does so with much less pain and risk during periods like market crashes and economic recessions. It matches what investors naturally want to do. That is, get out of the market when things are scary and volatile. But there's a very important catch. While it's easy to get out of the market when things are scary and volatile, it's much harder to get back in as volatility comes back down. And often volatility comes back down very quickly, much faster than most investors would feel comfortable coming back into the market. And that part is critical for the strategy's success.
Looking forward, it's hard to predict if volatility will rise or cool off. When the VIX goes down to 19 or 20 after a spike, it means that the markets just experienced a shock. But when volatility lingers above 35, and especially north of 43, it's a warning sign for the market. So whichever strategy you choose, be wise in how much you risk. The last thing you want is to be forced to pull out of the market at the wrong time.